Welcome to Investor in the Family Radio, a podcast dedicated to helping you make better investments in less time so you can live more life. My name is Brian Bain, and I'm your host. You can find more shows and other valuable content at investorinthefamily.com. Well, on today's show, we have Adam Gallus, the Dividend Sensei. Adam, welcome back to the show.
Oh, so glad to be back, Brian. Always a pleasure.
Absolutely. Could not agree more. And last time we were together, we had a really fun episode, and we talked a lot about if you could only invest in 5 companies. We went through 5 different companies that you just saw, like as far as the best dividend yield, best overall total growth, and best management, safety, all that kind of stuff. And we had a great time. And today we're going to focus on another article you wrote recently on AbbVie. And for people who haven't read that article or maybe need a refresher, could you kind of kick us off on your thesis on AbbVie and kind of what your thoughts are?
Sure. So the article is called 5 Reasons I Just Quadrupled My Position in This High Yield Blue Chip. And basically, last week, slightly about a week and a half ago, AbbVie reported earnings. And I mean, if you just look at it objectively, it was absolutely fantastic. I mean, for example, if you look at the last the first half of 2018, revenue growth 20%, EPS growth 33%, free cash flow per share growth 45%. The dividend, they hiked 50% by a 2-stage process. And it was just absolutely, they continue to kill it. They're my absolute favorite pharmaceutical stock. And the price just fell off a cliff down to 89. Part of that, there was a article by Citron Research. He's calling it the next great, short stock you should be shorting. And so it fell to 89. So
from where? Again, I mean, that was about a 25% fall, right?
Well, yeah. So it was down in the last few months. It was down about 25%.
Okay.
And so, I picked it up after it had a disappointing drug trial result on something called Rova-T. And so it fell about 15% to 97. That's when I first picked it up. And so then it fell to 89. It was at 91 the day I was writing the article. And, after I did the valuation models, I saw it was about 29% undervalued. And the first thing that sprung to mind was a famous Buffett quote: "When it's raining gold, stick out a bucket, not a thimble." And I had been thinking about consolidating because, I had a 61 stock portfolio at the time. And all of them solid companies, double-digit total return potential. But, when you see something like this, a grade A blue chip that, it's technically, it was spun off from a dividend aristocrat, which technically by the S&P rules makes it still a dividend aristocrat. So, looking at this thing and it's so undervalued, it's growing so quickly. And as we'll discuss in a moment, there's like so many growth catalysts and just reasons to love this company. And so I decided, you know what, consolidation is a solid idea, going from 61 great stock to your 27 best ideas. But I plan to do it over 8 weeks. And I was like, you know what, the opportunity is now. You got to strike while the iron's hot. And so I went ahead and I consolidated a whole bunch. I think it was like half a dozen companies, smaller positions that, weren't really at the core of my portfolio strategy, which is, maximum high but safe yield, the fastest possible long-term dividend growth, and the best possible valuation in terms of undervalued stocks at the moment. And so I quadrupled my position over a 2-day period, around $91, lowered my cost basis from about 97 to 92. And the stock popped up nicely to 97. Now it's pulled back down to about 94. And I'm just, I'm fine with that, because just the nature of pharmaceuticals is on one hand, people say, medical is highly defensive, meaning it's recession resistant. No matter what the economy is doing, people always need drugs. And that's true. On the industry-wide level, drug sales generally, they're rising 3-4% a year worldwide. But at the company level, oh man, pharmaceutical, it is such a tough industry because you've got the same wide moat characteristics like the patent protection that causes such high margins, and it also causes this boom and bust blockbuster cycle where a drug will take off and earnings will soar, and then rivals will come in with different drugs targeting the same conditions or come out with biosimilars that are using slightly tweaked formulas to basically do the same thing. And so when you finally lose that patent protection, then sales typically fall off a cliff. And so you've got this, basically it's like a hamster wheel where companies have to invest tons of money, oftentimes 10, 15, even 20% of sales into R&D for these giant drug development pipelines. And all of it's just to, if you can achieve 1 to 2% over time steady revenue growth, that's considered a success. And it's like, okay, so maybe you can drive with buybacks and economies of scale. Maybe you can get 5 to 7% earnings growth and, 5 to 7% dividend growth. And so, then of course you've got all the other risks. It's like in terms of whether or not drugs will actually make it to market, because only about 1 in 10,000 potential treatments actually makes it through the 10 to 15 year FDA development cycle.
10 to 15 years. That's remarkable.
Oh, absolutely. Yeah. And that's the thing is like patents, they last for 20 years, but you have to file them at the start of the process. So if it takes you 15 years
right.
And even if the drug gets approved, you got 5 years before, the patent expires, and now you're facing all this new competition.
Yeah. I saw that chart you put in your article, and I thought, well, that's kind of discouraging.
Oh, yeah. And the cost. I mean, that's the
right.
thing. Is like the cost of developing some of these drugs, if you go it alone, it can be as high as $2.7 billion. That's why companies, they do joint ventures and they split the risk. And so, they might have a 50% stake in a drug. Even then, it costs them on average about $850 million to bring a new drug to market. And
not to shift gears too much, but you can see a little bit why a lot of companies want to charge so much for the drugs. Again, I don't want to change topics, and I'm not going to get into those waters and defend anything, but you can see how, at least in some cases, that temptation exists for sure.
Oh, yeah, absolutely. And so now the thing that excites me about AbbVie, and one of the reasons that, it's been so beaten down, and one of the major things that bears keep pointing out is that right now, so AbbVie was basically, it was spun out off of Dividend Aristocrat Abbott Labs, which is similar to Medtronic. And basically the reason for that was Abbott wanted to, they wanted to focus on a very stable business. And they said, okay, well, they had at the time Humira, which is it's an immunology drug that's used to treat things like, arthritis, Crohn's disease. And it was blockbuster at the time, but they said, well, eventually this thing is going to taper off and we don't really like the model. So we're just going to spin off, AbbVie into its own separate thing. And we're going to put in good management and tell them, okay, go ahead, diversify and do your own thing. And so they started out, it was pure Humira. And over the years, Humira, they just keep expanding their indications, keep expanding into new markets overseas. And so it fast became the best-selling drug in the world. And now it's actually the best-selling drug in history. It's now selling $20 billion a year. And it's still growing at 10% a year. Now, that growth rate, of course, is slowing down. And in Q4, biosimilars or competition is entering in Europe. But the thing to remember about Humira is 2/3 of its sales are in the U.S. And AbbVie just cut deals last year with Amgen and Samsung Bioepis to push off any biosimilar competition until mid-2023. And so in the U.S., which is their key market for Humira, they've got no biosimilar competition coming for the next 5.5 years. Sales are still growing strong, and they're expected to basically taper off around $21-22 billion. But to give you an idea of just what kind of cash cow there is, I mean, right now, Humira accounts for 63% of their sales and about 70% of their earnings. And that's the major risk that people point out, is that, wow, these guys, they're so dependent on this one mega blockbuster. And so it's like, look at Gilead. Gilead Sciences is another former high-flying biotech Wall Street darling. They came out with 2 blockbusters, Harvoni and Sovaldi, to treat hepatitis C. They tripled their sales within 2 years. And then the problem is, when that crashed, now they're basically saying is 7-8 years where sales will just continue to fall the entire time.
Yeah, that's not good.
And the thing about the difference, of course, is hepatitis C, that's a cure. That's not a treatment.
Right.
It's 12 weeks. Boom, you cure up. You never have to take it again. You basically take every 2 weeks forever. So
Humira, that's how Humira works.
Yes.
Right.
So for Humira, it's a totally different business model. It's far more stable. And to give you an idea, analyst firm Evaluate Pharma estimates that in 2024, Humira is still going to be generating $15 billion a year in sales and still be the world's best-selling drug. And that might extend into 2025 because AbbVie management says that their models say it's still going to be generating about $12 billion in sales. And so you've got, reason one to love AbbVie is, yes, it's still Humira, but it's a very stable, still growing cash cow. But it is so much more than that.
Well, real quick, earlier, and if you're saving this for later, that's fine. But earlier you made a comment about why it's been beaten down. And I'm not sure if we finished that thought. So are you going to come back to that later on, or should we jump into that now, as far as why it's is down like it is?
Well, so there's several reasons. One is the short attack by Citron Research.
Right.
Basically, he's citing the same risk that everyone's basically been citing, that government policy could change, that FDA says that they want to be more aggressive with biosimilars going forward. But as management pointed out in the conference call, none of the policy proposals would actually affect biosimilar competition for Humira before mid-2023. So in essence, it's not going to actually affect them. Now, during the earnings, ironically, analysts, what they fixated on was, Humira sales have slowed just to 10%. And yes, you've got 2 other major blockbusters growing at 60% and over 100%. But, Humira it's starting to slow down. And so it's like, the thing is, if you want to increase your diversification, then you're going to need other drugs to grow quicker. And so Humira slowing down, when you're selling $20 billion a year, how much faster can you grow than double digits?
Right.
I mean, really, you don't need much growth off that at all. And so that's the thing so basically the earnings report, even though it was fantastic, Wall Street, again, I don't know what they were expecting, but they were disappointed by that. Then you had the short attack. And so that's basically the thing with all pharmaceutical stocks. You got these headline risks.
Right.
Earnings come out, you got really sharp volatility. If a drug trial comes out that's disappointing, you can see a major crash. And then sometimes, it's just like analyst downgrades or short attacks and puts out a report basically saying, hey, this thing is going to 69, from the 90s. And so that kind of volatility, some people look at that and say, oh man, that's just another reason to avoid it. But when it comes to a blue chip like AbbVie, I look at that's a golden opportunity. That's just a great opportunity to really double down on it, or in my case, quadruple down on it. And then, as I explained in the article, while Humira is like, for the short term, 2018 and 2019, Humira is going to be the dominant factor. They are far more than that. For like I was alluding to earlier, they've got 2 drugs, hepatitis drug Maviret and Imbruvica, cancer drug, that Mavuret right now is selling $4 billion a year and growing at over 100%. Now, because that's a hepatitis drug that's also like what Gilead does, they cure it. That's expected to taper off and stabilize, but it's still going to expect it to generate $3 billion a year in stable revenue over time. Meanwhile, Imbruvica growing at 60%, that's expected to hit about $7.5 billion in peak sales in 2022, according to Evaluate Pharma, and it's set to become the third best-selling drug in the world. And so,
okay, just real quick, you said Mavuret is expected to level out at around $3.5 billion a year in sales. Is that right?
$3 billion like past 2020.
Gotcha.
Over the long term.
And then and Imbruvica around 7.5. Okay.
Exactly. So you've got those two that's going to get them to 2019 and 2020 to help boost their growth. And then after that, that's when the biggest reason to love AbbVie kicks off, and that's the second best drug development pipeline in the industry. And that's according, again, Evaluate Pharma, which estimates that between 2018 and 2024, that pipeline, which has 74 different treatments, so for drugs that treat 74 different conditions, that's expected to generate $22 billion in sales. Now, in 2019, they have 3 blockbusters that are expected to receive approval, and 2 of those actually already received FDA approval, but they've got their major indications to expand their different treatments in different markets. Those are expected to come in 2019.
You said how many? 2 or 3 blockbuster drugs coming?
Yeah, three blockbusters coming in 2019. And beyond that, it's absolutely amazing. Their total drug development pipeline, those 74 treatments they're working on, they're specializing in immunology, oncology, so cancer, and virology. And those markets alone are numbered total $200 billion a year in drug sales. So that's the market they're going after. And then to give you an idea of what they think that they can do, and management is very good at their models. They have risk-adjusted models that factor in the risks of drug trial failure. They say that by 2025, their sales are going to hit about $45 billion a year. Humira will be just 12 of that. So they'll have about $33 to $35 billion in non-Humira drugs. And then beyond that, that's where their neuroscience drugs for things like Parkinson's and Alzheimer's, they've got 6 major potential blockbusters in development for that. And so the bottom line is that in an industry where 1 to 2% annualized sales growth is considered success, AbbVie is set for 5 to 5.5% through 2025. And analysts think that a combination of ongoing cost cutting, that strong sales growth and share buybacks should be able to grow earnings per share and free cash flow per share by about 20% a year over the next decade.
Wow.
Now, of course, all long-term forecasts need to be taken with a grain of salt.
Sure.
And especially in the pharma industry, which is so high risk, all these uncertainties about whether or not drugs actually make it to market, what kind of market share they can get. But I mean, conservatively, I'm only modeling 10%, earnings growth. Maybe 15 is realistic, but basically, if you look at their payout ratio, which is right now about 44% of free cash flow, then you're talking 10 to 15% realistic dividend growth over the next decade, and the stock is yielding 4% right now.
Well, and to think about from the risk perspective and everything else, like you said, any projection obviously is uncertain because it's still to be determined. But that's where I think so much about management. And I know in your article you talked about CEO Ricky Gonzalez and his experience at Abbott before AbbVie, and then he obviously came over to become leader of AbbVie when they spun it off. But to me, that's a huge component there as well.
Oh, absolutely. And that's the thing. What I love at the end of the day, management is absolutely key because you got to trust these people. I'm not someone who wants to track a company every day and I check the quarterly results, sure. But at the end of the day, my idea is you check in once or, for a blue chip, maybe every 2 years to make sure that the thesis remains. And the rest of the time, hey, I'm trusting management. You know your industry, you know how to adapt to competition, you know how to, most importantly, how to allocate capital efficiently. And AbbVie's is definitely top of the line. 36% returns on invested capital, 34% free cash flow margin. They're like the Apple of the pharma world. They're minting money. And another thing I love about it is, I want a culture of innovation. And so the third thing I pointed out that it's a bit more speculative, but another reason that, potentially is they have this moonshot program that it's a joint venture with Alphabet, parent company of Google, called Calico. And so Alphabet, they have 2 subsidiaries working on a cure for aging. And it's like literally trying to first treat the diseases of aging, understand it, eventually slow it, stop it, and then reverse it. And so in 2014, AbbVie was chosen to be the joint venture partner for Calico. So they invested $250 million and provided some researchers. And so now they're developing about 24 potential treatments, mostly focused on cancer and things like Alzheimer's. But the great thing about this joint venture is basically AbbVie provides half the funding and some of the researchers. They get exclusive rights to any commercial products. So if Calico comes up with, various kinds of treatments for cancers, breakthroughs, and even things like a cure for Alzheimer's, AbbVie is going to market that. And if they come up with, in a few decades, if they actually come up with a way to slow, stop, or even reverse aging, an immortality pill, if you will, again, AbbVie is going to be the one marketing that. And it's like just the other day, I read that according to Credit Suisse, the United States has over 16 million millionaires. Worldwide, it's over 50 million. And so just to give you an idea, it's a speculative thing decades down, but that's the way the moonshots, work is, how much would a millionaire pay to live forever?
Sure.
I mean, $1 million a year. Now imagine multiply that times 50 million people worldwide. And by the time that they actually invent it, it's probably going to be over 100 million. And so as I pointed out in my article, if they came up with a treatment for aging, an anti-aging medication, if you will, you could easily, the sales of that alone would put Humira's peak sales to shame. We're talking potentially 50 to 100 billion a year from one drug. And
it'd be the great pharma killer. It'd be the last pharma you need, right? I mean, in theory.
I mean, it would be enough to probably make AbbVie $1 trillion stock. And so, I mean, it's that, that's, For sure, Calico joint venture is not the sole reason to invest in the stock. But when you
it's called a moonshot program for a reason.
Absolutely. When you add in the best-selling drug in history that is still growing strong and is going to remain the world's best-selling drug for the next 7 or 8 years, on top of the blockbusters they have now to help drive growth through 2020. Add in the 3 blockbusters they got coming in 2019, and then another 71 that are coming by 2025, and another 6 beyond that could be, multi-billion-dollar blockbusters for the treatment of neurological conditions. All of it tied together with one of the industry's top management teams that's proven that they know how to navigate the pitfalls of drug development and all the regulation and the political risk and uncertainty. And on top of that, you got a valuation that even now with AbbVie, popping up, it's still about 27% undervalued.
Well, and that's as I'm listening to you talk and as I looked at your article, those are a lot of the components that I think were so central and key for me, because obviously, like you said, the future is unknown, and that moonshot program could be absolutely phenomenal game changer if it works out. There's obviously a lot of question marks there. But the thing is, if AbbVie today based upon current numbers and even a very conservative numbers, looking a few, 3 to 5 years out, if AbbVie today is undervalued, and we can talk a little bit of valuation here in a minute, but if it is undervalued now, then it seems that, okay, then the question is, well, do we have reason to believe they will be, and they have had great success so far, largely based upon one drug. So again, the question is, can they diversify that and do it again? And it sounds like they've got a few drugs currently released and some others in the pipeline that seem to indicate they have that potential to continue to create more blockbuster drugs, and they've got management that is beyond proven. And so to me, those are the key things, because if I can't predict the future, I want to be able to know how likely is current management able to continue past success and even build upon that success. That's what makes me excited about a company like AbbVie. That seems to be a lot of your thesis as well.
Oh, absolutely. They're the complete package.
Right. Well, I mean, it sounds like a kind of a token statement, but when you say like they are the Apple of the pharma world, I mean, you look at the gross margin numbers that I know they're in your article. I think you mentioned them here as well.
75%.
Yeah, I mean, it's just ridiculous. It's like they're selling iPhones in the form of drugs, And so that great management, a strong pipeline, and like you mentioned, the fact that Google chose to partner with AbbVie of all companies shows that Google seems to think a lot of their potential and quality as well. So I mean, those are a lot of, as typical in our interviews and with what you bring to the table, those are a lot of really strong, not a lot of speculative, crazy things. This are really solid core things to focus on and build an investment thesis on.
Absolutely.
Well, let's talk, in the time we have left, let's talk a little bit about valuation. And I know that you shared some valuation metrics in your article, and I know that, there are some comments in the comment section that, saw things differently. They may have been in the minority, but I'd like to hear kind of how you get to the fact that they are 27% undervalued.
Well, so as explained in the article, there's dozens of different valuation metrics that you can use. There's all these different models, and if you use combinations, there's hundreds or even thousands of them. And so, ask two different, financial analysts, how to properly value a company, you'll get three different responses. And so, knowing that nothing is perfect, and like you said, the future is uncertain, and even if you use trailing, something like trailing earnings, well, that's assuming that those earnings are going to be stable over time. So you're still making assumptions about the future. So what I like to do is like to use a combination of time-tested methods that, while none perfect on their own, that if we put them together, they can give us a general idea. And at least, we can confirm if one says something is like, this is 40% undervalued. Well, okay, well, let's double check that with, something else that's historically proven pretty accurate. And so, I use a combination of things. I'll look at something like the forward PE, and then I'll use a formula developed by Benjamin Graham, Buffett's mentor and the father of modern value investing. And basically, he surmised that, if a company is not growing at all, then a fair value would be 8.5 times its earnings divided by the discount rate, which is whatever your goal return is. For example, if you're shooting for 10% and a company has a very stable business, but their earnings aren't growing at all, then paying 7.8 times earnings would get you, that would be a fair value, and anything under that would be a great buy, and you should definitely double down on that. So the formula is 8.5 plus 2 times the long-term expected conservative growth rate. And then you take that and you divide that by the decimal form of your discount rate. So for example, it's 10%, it'd be 1.1. And my personal discount rate that I use is 13%, because that's my target total return. And so looking at, again, to be conservative, I'm using half what analysts are expecting for AbbVie. So 10%, not 20. And then using that formula, basically it says, well, okay, so a fair value for AbbVie is 25 times earnings at today, basically for today. It's trading at less than 12 right now.
You said a fair value would be 25 times earnings?
Yes.
Okay.
So it's trade instead of so 25 is fair, it's under 12. And so it's like, okay, well, what does that tell us? Well, another way we can use the formula is to say, well, okay, so using that formula and using, what the father of modern value investing would say, is a reasonable expectations. How much is AbbVie's current PE of under 12 pricing in terms of future growth? The answer is 1.6%. Now, you can say there's a lot of risk, and Humira sales might slow down, and maybe their future pipeline won't have as many successes as we thought and gain the market share. Are they going to be able to beat 1.6%? If so, it's undervalued. And so, again, this tells us, it looks like a screaming buy.
Well, and again, and you go back to the management as well. Like, I can sit here as an investor and who is I'm familiar with a lot of pharma and biotech metrics and the industry, but I'm no expert by any means. And I'm going to go on a limb and say that probably most of our listeners and readers are not experts on biotech either, even though they may be very knowledgeable. And so that being the case, if I'm looking to make an investment in a company like AbbVie, again, not to put everything on this, but going back to Rick Gonzalez as a CEO, who clearly, if there's an expert in the industry, it's going to be this guy. He's been there for decades. He's proven to be able to get them where they are. And I assure you, is highly incentivized, more incentivized than we are for that company to be successful. And so again, he clearly has shown he can proven that he can lead a team to do this. They've been doing it. They should continue to be able to do it. And if on top of that, as your valuation metrics are pointing to, the company is very undervalued as of today, again, it starts kind of screaming at you like, why aren't you buying me?
Oh, absolutely. I mean, that's the thing, it's like every valuation method I threw at AbbVie, the results, they always come, they all come back. It's a screaming buy. Sure. And so that's the thing is like at the end of the day, when I put it all together, including some very, very conservative discounted cash flow stuff from Morningstar, which some of their assumptions, I mean, what I love about Morningstar is that their fair value estimates, it's 100% long-term, it's 100% fundamental focused, and their growth assumptions are just crazy conservative, below not just analysts, but below even management's guidance. And for example, here, Morningstar basically, some of their stuff is like literally ridiculous. They're saying that, they're saying, oh, it's only 7% undervalued because in 2020 they expect Humira will have biosimilar competition in the U.S. Well, that's the thing is just like they just battled in court and they just got settlements and deals struck with all their major rivals that were going to launch those, biosimilar rivals to say, no, it's going to be June of 2023.
You're right.
And so even if you assume basically like just like crazy, not possible scenarios. And then I even factored in that Morningstar's estimate into mine just to make sure that, it included every, a consensus view. I came up with 29% undervalued. So a fair value is basically 129. It's trading at 94 right now. And so when you have that, when you have this, the combination of industry leading, pipelines, the management to execute on it, the proven profitability that just shows you that the best capital allocation in the industry, a rich 4% yield that is safe and likely to grow that dividend at 10 to 15% a year. And then you throw on top of that it's 26% undervalued from today's price. Then suddenly, what kind of total returns can you expect? Suddenly the number's 20 to 25%. So even if you take that lower estimate, 20% total returns, to give you an idea, that would mean over the next decade, a 700% return or 8 times your money. And to give you even more context, Vanguard, BlackRock, and Morningstar estimate that from the current valuations, the S&P 500 over the next decade can be expected to generate returns on an annualized basis of 0 to 5%.
Right. Yeah,
And
I've seen
AbbVie
that.
is
Yeah.
realistically looking at 20.
And you said even today, and you said today your valuations show AbbVie as being about 26% undervalued, and so you have a price target. What was it again? A 120.
So 129 is my estimated intrinsic value,
Right.
based
Gotcha.
on the latest results. Obviously, the next earnings when they come
Of
out is
course.
probably going to go up.
Of course. And you're getting to the total return of 20% annually. Obviously, that's the 4% yield plus whatever return it would need to have to be able to start getting back to fair value, then factoring in future growth as well.
Yeah.
Okay.
So that's the core of my strategy. I always look at, a nice safe yield, fast dividend growth with a long growth runway that's realistic, and then throw on top of that really undervalued. You put these three things together, oh man, history shows you're going to absolutely crush it.
Awesome. Well, Adam, as always, fantastic stuff. Thanks so much for joining us on the show, and thanks for sharing all your great content on Seeking Alpha.
Oh, my pleasure.
The information and opinions contained on this podcast are for educational purposes only. The information does not consider the economic status or risk profile of any specific person. The information and opinions expressed should not be construed as investment trading advice and does not constitute an offer or an invitation to make an offer to buy and sell securities.